The price-to-book ratio is a common metric used by investors to compare a company's market price to what it actually owns. It is often abbreviated as the P/B ratio and helps investors identify if a stock is potentially undervalued or overvalued. To calculate it, divide the current market price per share by the book value per share found on the balance sheet. A low ratio might mean the company is a bargain, but it could also mean the business is struggling to generate value. While P/B looks at what a company owns, the price-to-earnings ratio focuses entirely on the profit the company generates. Different industries have different norms. Always compare a company's ratio against its direct competitors rather than the entire market. Remember that no single ratio tells the whole story. Use it as one tool among many in your research process. Understanding valuation ratios is a key step in becoming a more informed investor. Subscribe for more financial basics.